Hello everyone, welcome to Blue Dragon Actual. So this video is a part of our Sparkle 1 course, and because of the GST and everything, as I kind of mentioned in my previous video as well, I was not able to the video recording process was not complete, and I was involved in the administration related activities because I need to finish this before a particular date so that we can launch the course and the user experience can be improved, that they can pay through debit card, credit card, payment gateway integration, and also everything should be properly audited and clear, right? Legal. So that's why we are waiting for this course to be launched. But this couple of videos have already been recorded, right? And this video that you will be seeing will be in Sparkle One course. And there are eight or nine videos that I've planned, and this is one of the sample of that video. So you can also gauge whether you are into whether you should be buying that course, and it should be priced, I believe, at 999, right? So it will be very cheaply priced so that everyone can purchase this course and understand. Now when interacting with people, especially even with senior people, I have seen that they do not understand the company structure of a life insurance, which is surprising because in valuation, or like in life insurance, the cream profile is valuation. So if you have worked in valuation and if you don't understand the company structure, that is kind of surprising, right? But I've seen people who have worked in valuation for longer than I have done, and they don't understand the company structure. So pay attention to this video, and this is only a portion of it. Like this portion is related to the non-participating one, and then in Sparkle One you can see about the participating product. In fact, in Sparkle One there is a master class on participating product which I have already recorded. So all of this would be covered in Sparkle One, and I believe 999 is a very kind of small price to pay for that. But yeah, that's what is our specialty. Like people say, like I've heard a comment or seen a comment where someone was saying that I did not know there is a fellow in actually coaching, right? And that is not something that you should be interested in. What you should be interested in is what is the knowledge level of that person. Whether he's fellow or not fellow should not matter to you. It's just a paper designation at the end of the day. Of course it helps, right? It helped me tremendously. I'm yet to get the certification, I have to do the process, but it helps, right? That is how society kind of gauges you. But in terms of knowledge, a person with knowledge, kind of good knowledge, will excel far beyond someone with just a paper degree. So that's where you should be interested in. If the person is fellow and the person has worked, so the person has clarity of knowledge, that is the person you should follow, right? And I believe in Blue Dragon Universe will bring that. So the next portion of the recording that you will be hearing would be on the Sparkle One course, and it will be created in that manner, in that phase. So I hope you enjoy this course, and also this will help you to choose the Sparkle One course and pay for it and buy for it, so when that course is actually live, right? So wait for the next part. Hello everyone. So this is the Sparkle One course, and this is our course related to what is the company structure components. Now here we are not going to talk too much about the side details, but we'll straight get away into the topic, right? So what are the components that make the company structure of a life insurance company? This is specifically in relation to the life insurance company, but it can also be applied to the general insurer. There is only one difference in life insurance company which is not covered in this video but will be part of the next video, that is participating product. Because in general insurance, participating product does not exist. In life insurance, participating product do exist, and that's why the company structure can be different. But in this video, what you are going to learn can be applied to any kind of insurance company, general insurance or life insurance, right? So these are the type of liabilities that, or these are the type of company structure that we'll see. First is liabilities and reserve. Now many people do not know that reserves are liabilities. So this is somewhere you should get that understanding that reserve is your liability, and actuaries calculate the reserve. So that's why actuaries are the owner of liabilities. Now let me tell you that understanding liabilities or calculating liabilities is much more tougher than understanding asset. Why? Because asset market value, I mean the valuing of the asset, right? Not the management of the asset. That is much more tougher. But the valuing of the asset is much more kind of easier. The reason is, in asset you can most of the assets are traded in the market, like bond, a stock, right? They are traded in the market, so you know the price. But in liability, the reserve, you are using some assumption to calculate the reserve. We have already gone through that in Sparkle on how we calculate the, the reserve. We have seen a paper example in Excel, right? So we understand that, right? How the assumptions are kind of used. And I hope you are enjoying the Sparkle one, because these are all the practical thing that we are kind of considering. And now you know that reserves are the liability of the company. The second thing that kind of builds the company structure is the margins. Now in some regulations like IFRS 4, margin might be part of the reserve. That is why it is called prudent reserve. But I have kind of considered the, the contemporary ones or the contemporary regimes like IFRS 17 or Solvency 2, where reserves mean best estimate liabilities and margins means anything that you keep over and above. If the best estimate, because at the end of the day this is an estimate, if the best estimate does not hold true, then the margin would come into picture, and that will help you, right? Next comes the regulatory capital, the solvency capital. Now it is in different regime, it is called by different names. And solvency capital, somewhere like in India currently it is factor based, like maybe 3% of the sum assured and 0.3% of the sum at risk, right? Values depending on the line of business or LOB of the business. So it depends. And one can see that in a regulation, there is a regulation called ARA, right? You can go to the IRD website, search for ARA regulation, but that is not important for us, right? So that is factor based, means that a percentage of sum assured and percentage of reserve or a percentage of sum at risk of that line of business would be considered as solvency capital. Now you can question why is a certain percent, why not 4%, why not 6%, right? So there is no justification for that. That's why those are kind of, these are methods which are going away, right? These are methods which are weaker. There is no judgment, that is just purely judgment based, right? So that's why these are going away. And what we are kind of doing is economic capital or risk based capital, and that's how IFRS 17 calculates the solvency capital, right? Or maybe Solvency 2 actually introduced that risk based capital concept. In fact, it was first introduced by Basel, right? The banking regulation. They introduced that after the 2007-8 crash, and then Solvency 2 body kind of bettered that, because life insurer carry more risk as compared to a bank for certain, in certain kind of situation, although a bank is more financially important to economy as compared to an insurer. So Solvency 2 body has bettered it, and IFRS 17 has kind of used that. These are also known as economic capital. Now, if the regulatory capital, the way the regulator wants your capital is, if that is same as the economic capital or risk-based capital, then there is only one capital, right? But in regimes like, Indian regime, where IFRS 4, where you are keeping some bit of IFRS regulatory capital, which is factor-based, then you are also keeping economic capital, right, which is kind of based on risk based principle. And depending on the risk, usually the economic capital is lower than the regulatory capital, right? But there might be some regime or some, some method of calculation, is just calculation method, right? The regulatory capital can also be greater than the economic capital if the company is have lower risk as compared to others, right? So that is why regulatory capital is going up, because it does not attach any risk to the capital. Now this capital is kept over and above the liability reserve and the margin. And this capital is used in terms of something which is happening once in a lifetime. For example, COVID, right? So if your estimates varies by a bit, then margin would take care of it. But if you're if you are facing a situation which you are not expecting, then your capital should take care of it. That is the real risk that you are facing. That is why it is called risk based capital. And it can be anything, like it can be a financial fraud, it can be a stock market crash, and all of this comes under economic capital. So the more exposure of risky asset you have in your balance sheet, the more riskier or more capital you require, right? So that is the concept of risk based capital. That is not what we are going to concentrate or study in. You just need to know the concept. But Sparkle 1 would not cover how risk based capital is. In fact, we are planning Sparkle 2 depending on the experience of Sparkle 1, which will specifically deal with economic capital. That will be much more smaller, because Sparkle 1 is the bigger one, right? It is for everyone. Now, if some people want to get deeper knowledge, for example, in embedded value, in analysis of surplus, in risk-based capital, right? These are the cream of valuation. This is the cream of life insurance. Once you understand that, there is nothing else that you need to understand, and those everything else is kind of the the over and above this, or the variation of this, right? It's simple to understand once you get that. So we'll be planning those, but that depends on the response that we get, because if people are not interested, people are not ready to learn Sparkle 1, then there is no point in creating another course. Then should be better off creating more papers, right? Because if people are that focused in papers, then at the end of the day, we are a company, we want to be profitable, we want to be the biggest coaching center in all over the world. So that's how we have to proceed. What the customer want, we cannot push our product in the customer, right? So it's up to you also to show that response. If you are not interested in this sort of knowledge, then you'll always be a paper actually, then you will be happy with that. Then we are also happy with that, right? Now we can't push beyond a particular level. So economic capital is something which is based on risk, and then there comes the free capital, which is not backing any liability, which is free. This capital you can invest in equity or non-listed equity, very risky thing you can do. There is no regulation over that, right? Now the funny thing is, there is no such physical existence of liability. As for example, if you run a chocolate company, because that is my famous example, and then there would be some chocolates that you'll be keeping, that is your inventory. If the chocolate does not sell within a particular time, it will get wasted, and that is your loss, right? That there is a physical existence of liability. But in life insurance, there is no physical existence of liability, right? So that is why it has to be calculated mathematically using the assumptions that we have already seen in the very first or second video of Sparkle 1, right? So I think that is clear. Now, that is why actuaries are required, because if this liability would not be required to be calculated, right? Then this is where we use the actual software to calculate this liability or reserve. If that is not required, then actuaries are not required. If somehow you can automate that, if AI can calculate the liability, all actuaries will go out of job, right? So that's a problematic situation for us if that happens. I don't see that happening in the next 10 years though, right? But anything can happen. So asset that backs the liability are regulated, right? So there is a regulation that you have to invest in corporate bonds or central government bonds or state government bonds or approved instruments, or only on maybe money market instruments. There are regulation over that. In fact, there is a investment regulation by IRDA. I think in 2011 it was released. Then it might be amended from time to time. So you can check that regulation. What are the approved instruments where we can invest, right? Whether the bond should be secured or whether the bond should not be secured. Whether it is a tier one bond, meaning there is be like there the claim would come after the senior bond, then there would be tier two bond. So there are different types of bonds, right? I'm not going to go into that, but these are the assets has to be regulated, right? And liability do not exist physically, because you can't determine or it's only in your head that some many people might die and for which I need to keep some reserve, and that is only in your head. You can't just put a physical existence of that, right? That's a mathematical number. That's why in profit, the reserves is calculated as mathematical reserve. That's the variable that takes out the reserve, right? Or gets the reserve for you. So it is calculated mathematically. Now this is the final slide, right? And this is the slide where you need to understand. So here, if you see this, this is the best estimate liability, right? Like I mentioned, then there will be margins, right? And then this is the capital section, which is where I have put the economic capital and regulatory capital. In IFRS 17 Solvency 2, there is no such distinction. They are the solvency capital is actually calculated using the economic capital method. Now, economic capital is a is a methodology, right? Economic capital is a methodology. Usually it will be called solvency capital, or maybe in solvency 2 it is called SCR, solvency capital requirement, to MCR, right? Like that. So economic capital is a methodology. That methodology is based on risk based capital, like how much risk your company carries, that much capital you should keep. If a company carries less risk, it should keep less capital. If a company carries more risk, it should keep more capital, right? That's the methodology. Now, sometimes regulatory capital and economic capital might be different. As I mentioned, economic capital is usually lower than the regulatory capital, but there might be some calculations where, or some regimes where regulatory capital might be smaller than economic capital, right? Especially if the company is very, very risky, in that case, that can happen, right? And finally, the final portion, which is the free capital. This is the capital that is not back. This is the capital that can be distributed to the shareholders in terms of dividends, bonus payments, right? Now, this is for non-participating product. In participating product, this structure will change slightly because there is a concept of estate, there is a concept of asset share, right? So we link. Now you need to see this video. You need to understand this video before you can go to that video, right? So I hope that is clear how the company structure is. And here you can see simple asset backing liabilities. These are regulated, right? And then this free capital can be invested anywhere, right? So all of this in the liability side or capital side, all of these are numbers. These are calculated mathematically. That is why actuals are required. But these are real deals, right? These are although this might not exist like today, asset might not exist because these are dematerialized, equities are dematerialized, bonds are dematerialized. So there is no physical existence, but they are traded in the market. So there is some sort of existence that you can feel, but for this there is no existence that you can feel other than number coming out of profit or GGY axis or Moses, right? Here these are traded in the market, so many people will be aware of this, right? So I think that's the bottom line of this presentation. I hope you understand how the company structure is. Then in the participating product, which will be the next video, right, will kind of link how asset share is related to maybe economic capital. I'm just giving an example. Don't take me like don't take this word as justified or correct. I just give an example, or maybe estate is related to free capital. How those are related because participating product is a company on its own, right? It's a company within company. That's the concept. So that's it. If you have any doubt, do write email to us. How can you write email? Go to the contact us section. If you go to the contact us section, you will see admin at the rate bluedragonuniverse.in. If you have any question, write the question to us and we'll respond back, right? So I hope you have liked this video, right? And yeah, thanks for purchasing the Sparkle One course and spread the word. All of us want to be good, right? Is the effort that you make will make you better and best, right? So I hope with that thought process, you can continue with the Sparkle One course and finish it and refinish it and revise it and refinish it so that you are very, very thorough with the actual concepts, right? So that no interviewers in the world can trouble you. So thanks for watching this video.